Today we're going to look at that big question. When you're running a small business in the UK, what is a limited company? How is it different from being a sole trader? And at what point should you become a limited company? I'm going to try my best to explain all of that today using Lego. Hiya folks, welcome back to the Small Business Toolbox. I'm Andy Mack and I've been self-employed in one way or another for well over 20 years now. Before I start, and as per usual, I need to tell you that I am not qualified in any way to give you business or tax advice, and before making any major decisions regarding your business, you need to speak to a legal or tax professional first. I'm going to explain things from the perspective of a small business owner, and then hopefully that will give you enough information that you can go to your accountant and ask the right questions. So in the UK, if you want to set up a small business, you've basically got two options. You can either be self-employed, and that encompasses sole traders and partnerships, or you can set up a limited company. There are a few other ways of structuring things in the UK, but by far the vast majority of small businesses will either be sole traders or limited companies. And by the way, it's important to explain that you're generally only considered as being self-employed when you're a sole trader or in a partnership. If you have your own limited company, no matter how small it is, then you probably won't be self-employed anymore. Instead, you'll be an employee of your own company. So if you're planning on running your own business in the UK, you're probably going to start out as being a self-employed sole trader. When you're self-employed, it's your business, you do the work, you're in charge. You might have employees, but ultimately the buck stops with you. You are the business. You pay income tax through a yearly self-assessment tax return, and after you've paid all the necessary taxes on your profits, what's left is yours. It makes no difference where the money physically resides, whether it's in a business bank account or a personal account or in a stash under your bed. Tax is assessed on your overall business profits. It's all done on trust, on the basis that if you get audited and blatantly try to screw the system, you'll go in prison for tax evasion. Something I get asked all the time is, when do I give all my paperwork and receipts and copies of invoices and things to HMRC? Well, you don't. HMRC only really cares about two figures at the end of the tax year: your overall turnover and your business expenses, and as explained in other videos, you pay income tax on your profits, which is your turnover minus your expenses. Now remember the words income tax, because we're going to come back to that shortly. In the UK, whether you're employed by a company or you're self-employed, you get a personal allowance of £12,500 per year, and after that you pay income tax at a starting rate of 20%. Of course, there's more to it than that, and that's why you should always have an accountant, but that's it at a very high level. The thing you need to remember is that you are the business. You can call the business pretty much anything you want as long as it doesn't end in limited. You do put your business name on your tax return, but HMRC don't really care. You could have 100 different self-employed businesses, but for tax purposes, it's you who HMRC are looking at, and it's also you who are liable if anything goes wrong. The key difference with a limited company is that it's an entirely separate legal entity. You can almost view it as a different person, and whereas when you're self-employed and you can call your business whatever you like, that absolutely isn't the case with limited companies. Your company name has to be unique and it's registered with Companies House. You're also given a unique company number when the company is first incorporated. If you want to check if a company name is available, you can visit companieshouse.gov.uk and you can look up information about any UK company. Limited companies are structured very differently from sole traders, since you've now got directors and shareholders. Now, when you first start out, you will probably be the only director and shareholder of your company. But it doesn't have to be that way, and you can structure things any way you want. You can have a board of directors who run the actual business, but then you can have an entirely separate group of people who own the actual company itself. These people who own the company are the shareholders, and these people who run the company are the directors. Another key thing that you need to get your head around is that within reason, anyone or anything can be a shareholder. In other words, limited companies can own other limited companies. There does have to be at least one human director per company. So in this situation, you'd have to have one director for the child company and one director for the parent company. But remember that the director doesn't necessarily own the company itself. So the key concepts you need to understand are: the company is an entirely independent legal entity. The directors run the company. If the company does something illegal, it's the directors who get in trouble. And directors are generally employees of the company. The shareholders own the company. They have the power to fire the directors if they want, and they can appoint a new director. But other than that, the shareholders should keep their noses out of the day-to-day running of the business. If they're not happy, they can always appoint new directors. You can have any number of directors, and directors can also be limited companies, but you've got to have at least one human director per company. And you can have any number of shareholders, and the shareholders can also be a limited company. And the shareholders don't have to be human at all. This way of structuring a business gives incredible flexibility to allow for growth, and it's more or less the international standard of how things work. So coming back to your micro business, where you are the only director and shareholder, what are the real world differences between your newly formed limited company and your previous self-employed business? Well, we've briefly touched on the fact that your company is a separate legal entity, and that gives you a certain amount of protection. Let's say you're working in an office and you're drilling a hole in the wall and you accidentally drill through a gas pipe and you blow the building up. As a self-employed person, that business could come after you for every penny you own. They could take your house, they could take your car, they could take all of your assets. Now, obviously, you should have some sort of insurance in place to protect you in that sort of situation, but if you've done something really stupid, the insurance company might refuse to pay out, and in which case the buck stops with you. There's really nothing to stop them taking everything you own. As a limited company, on the other hand, they can only really come after the assets of the company. They can only come after the stuff that the company itself owns. It's nothing to do with what you personally own. So assuming the company doesn't own your house, then you should be relatively safe. That doesn't mean you're completely off the hook. Directors can still be sued for negligence and whatnot. But generally speaking, your limited company will put a bit of a barrier between you personally and your customer. So in the same way that humans have to pay tax through income tax, companies have to pay tax as well, but it's through a different tax system known as corporation tax. At the moment, the corporation tax rate in the UK is 19%, so very slightly lower than the income tax rate. But there's no personal allowance. If your company makes £1,000 profit, then you're going to be paying tax at 19%, which would be £190 tax, and you would be left with £810 after tax. But never mind that, because you can't touch that £810 anyway, because that £810 doesn't belong to you. It belongs to the company. You can't just help yourself to money that's sitting in a company bank account without going through the proper channels. If you do, it's theft or embezzlement, and it carries significant criminal penalties. So how do you get your money out of your limited company? Well, as I say, it's not your money for a start, it's the company's money. And people have literally written books about profit extraction. This is a huge topic. You know, when you hear on the news about companies with weird structures and like subsidiaries set up in tax havens all around the world? Well, that's what that's all about. The holy grail is how do you take money out of a company while paying as little tax as possible. Now, this is an enormously complicated subject and not something I'm going to be going into on here, and it shouldn't really affect you as a very small business anyway. So for now, we're going to keep things simple and we're going to assume there's only two ways for you to get money out of your company, and that is as wages as an employee or as dividends. So let's talk about wages as an employee first. Remember what we said about the fact that the company doesn't get a personal allowance. There's no such thing as a personal allowance in the world of corporation tax. Well, that doesn't mean that you personally don't still have a personal allowance, and you should make use of that. When you pay yourself a wage from the company, that reduces the company's profits. Let's say, for example, that the company happens to have made exactly £12,500 profit. Well, you could take that £12,500 as a wage, and because that's the same as your personal allowance, you would end up paying zero income tax and it would reduce your company profits to zero, so you would also pay zero corporation tax. It's in exactly the same way as if you earn £12,500 as an employee or as a self-employed person. There is a little bit more to it than that, but you kind of get the general idea. So that sounds simple enough, doesn't it? Well, yes, but the only problem is you've got to set up a payroll system. You can't just help yourself to money out of the company bank account. You've got to formally pay yourself. And by the way, congratulations, you're now an employer. But don't panic, most accountants can run payroll for you and it's not very expensive. It's a fairly straightforward process, but it does mean you'll now be submitting monthly payroll submissions to HMRC because you're now going to be part of PAYE, pay as you earn. Don't attempt to do this yourself unless you've got a lot of spare time on your hands. You're going to have to cater for things like employers' NI, employees' NI, student loan contributions, pay slips, yearly P60s, and all the usual sort of stuff that payroll departments have to handle. Get your accountant to help out here. It's really not cost effective to do it yourself. The other main way of extracting money from your company is through dividends. A dividend is a payment that a company can make to shareholders if the company's made a profit. And the good thing is that dividends get taxed at a significantly lower rate than normal income tax. I think off the top of my head it's about 7.5% or thereabouts. Unfortunately though, dividends don't reduce your company's corporation tax liability because dividends are paid on profits after tax. This is where an accountant is worth their weight in gold because they will work out the most tax efficient way of doing this for you. It's not something I'm going to explain how to do on this channel. It's far too complex. So at what point in the progression of your business should you consider turning it into a limited company? Well, it's entirely up to you. I've had situations where I've wanted it to be a limited company from square one, and I've had situations where I've never wanted it to be a limited company. All I would say is, if your self-employed business is making more than £20,000 per year profit, I would definitely be having a chat with your accountant about it and try and weigh up the pros and cons. And if you're making more than £40,000 a year profit, then you will almost certainly save a significant amount by going limited. So hopefully all of that explains some of the positive reasons for becoming a limited company. But what are some of the negatives? Well, probably the biggest negative is higher accountancy fees. The structure of a limited company is much more complex than being a sole trader. You're going to have accountancy fees for preparing your formal corporation tax accounts and doing your mandatory paperwork for Companies House. You'll also have to pay for payroll and you'll probably have to still do a self-assessment tax return as well. Although that should be significantly more simple than a return as a self-employed sole trader. Another disadvantage is that you're in the public eye a lot more. Everything you do as a limited company gets put onto Companies House and anyone can do a search on Companies House to find paperwork about your company from the day it was formed to the day it was dissolved. There are ways and means of hiding personal information on Companies House, but if privacy is a major factor for you, then a limited company might not be the best choice. I would suggest you go onto Companies House, have a look at the sort of information that's out there relating to limited companies that you know about, and if you're comfortable with people finding that sort of information about you, then plough on. If you're not, then think of a different way of doing it. Not really a negative, but you do have to have a separate business bank account if you're a limited company. Remember, the limited company is a separate legal entity. It can't be using your personal bank account. I've also heard a few people getting a bit confused with VAT and limited companies. VAT works in more or less exactly the same way. You've still got the £85,000 VAT threshold. If you're below that in terms of turnover of your company, you don't have to register for VAT. It's not correct that if you're a limited company, you have to be VAT registered. Same rules as before. £85,000 turnover threshold for VAT. So do the positives outweigh the negatives? Well, on the plus side, you've got the limited liability of a limited company. So a bit of protection if things go horribly wrong. Also, your business finances are going to be totally separate from your personal finances. So if you got a corporation tax audit, the likelihood is they'll not look at your personal finances at all. You've also got the advantage of having a totally unique company name, and the perception of being a limited company can often be quite advantageous in various business situations. Another thing worth mentioning, especially if you're thinking of setting up as a partnership or perhaps several people are going to be involved in the business, it's much easier to structure that as a limited company because you just allocate shares as per how much involvement or how much ownership of the business you want those people to have. Briefly mentioned it before, but it can be significantly more tax efficient to be a limited company. You can structure the business for growth in a way that you wouldn't be able to do as a sole trader, and you can also structure the business to potentially sell it one day. It's much easier to sell a limited company than it is to sell a sole trader business. So I'm sure you're dying to know what sort of costs you're going to be looking at to go limited. Well, you can set up a limited company very, very cheaply. I generally always get my accountant to do everything, and normally it costs about 120 quid to get them to set up a limited company, but you can do it yourself much cheaper than that. But as I say, I generally advise get your accountant to do it, and then you can just hand it all over to them if something goes wrong. In terms of yearly accountancy fees, that can vary dramatically. I've heard of some people getting corporation tax accounts and companies' house submissions done for as little as £300 a year, and I've heard of some being charged over £2,000 a year. Personally, I normally pay about £600 a year for my corporation tax accounts. That doesn't include payroll, but payroll is generally pretty cheap, normally about £5 per payslip per month. As I say, it's the sort of thing that it's just not worth doing yourself. So I would say a reasonable ballpark is £1,000 a year on accountancy fees, but it could be anything between £200 or £300 a year and a couple of £1,000 a year, depending on how complicated your business is. The most important thing you need to bear in mind in all of this is that limited companies are way more complicated than sole trader businesses. I would never try and do a DIY limited company or DIY corporation tax returns. I have always had an accountant involved. I do not suggest attempting to do this unless you are a qualified accountant yourself. So, in a nutshell, if your profits are low and you want to keep things simple and you want to keep things private and you're not particularly bothered about business growth and you're happy to just do your yearly kind of self-assessment tax returns, stay as a sole trader. On the other hand, if you have higher profits or you want to build your business to make it scalable for growth and potentially selling it one day, if you want to limit your own liability and put a bit of a barrier between you and the customer, and of course if you just want to pay less tax, then I would suggest you speak to your accountant about going limited. The thing is with an accountant is that they're going to know much more about your personal tax circumstances than probably anyone else. And it's a bit like, if you feel ill, you go to a doctor. If you want someone to reduce the amount of tax you're paying, you go to an accountant. That is their job. Have a chat with a good accountant and see what they say. As per usual, any questions, pop them in the comments below. I might do a little bit of a follow-up of like Q&A on this topic because it is quite a big topic. For now, if you want to watch more UK related small business videos, then don't forget to hit subscribe. Take care folks. Tatty bye.